What is going on, everybody? Kyle Williams here with Clover Trading. In today's video, we're going to talk about the 5 things that you need to know as a beginning short seller in the world of the stock market, especially in the world of penny stocks, which is my particular favorite part about it. But again, the 5 things that you need to know when you're going to get started short selling. Anyways, like and subscribe. Let's get started and jump right in. So the first thing we need to know is the unlimited amount of losses that are possible when you short sell. This scares a lot of people away from short selling, which I do not blame them. When you're a beginner and you're already worried about putting in, your first account's worth of money, your hard-earned cash, and you hear the fact that short selling can lead to unlimited losses, that is scary. Now let's talk about that. Let's dive deeper into that. Let's compare it to going long a stock. Let's say buying a stock, you're bullish, right? When you buy a stock, let's say you buy a stock at $10 per share, and that stock over a month, 6 months, a year, 10 years, however long you want to hold it for, ends up going to $0. It becomes worthless, it goes to zero. That means any money you've had in that stock, given that you didn't leverage, given that you bought the amount of money, or you put the amount of money you put in that stock is all that you could lose, right? You didn't buy it, you didn't use your broker's money, you didn't use your grandma's money, right? You didn't leverage up. If you just put in, say, $10,000 and that stock goes to zero, well, you just lost $10,000. You lost 100%. There's no other downside. The worst you could lose is 100%. When you short sell and you're betting a stock to go down, you're bearish. Let's say you shorted at $10 and that stock goes to 20. Well, now you're in 100%. But can a stock go much higher than 20? Of course it can. And then it goes to 30, and then 40, and then 50. And all of a sudden you're down 5x from $10. That's where these unlimited losses comes from. Because if you don't cut your loss, if you don't manage your risk when you're short selling, you theoretically could have shorted Apple in, call it, 2000, 2001, 2002, during the dot-com boom, or even the bottom of the dot-com boom, let's call it, and you just held your short and you'd be down thousands of percent. Why? Because people who bought Apple at the bottom of the dot-com boom or in that recession are now up thousands of percent, right? They bought when Apple was, who knows, 5, 10, 15 bucks, and now it's well up over close to 200 bucks. So you see that example? If you're short something like that and it goes that high over time, or maybe even a short period of time, those losses are unlimited. Now, how do we protect against that? You heard me say it earlier, you need stop losses. You need to know that you're going to manage your risk, that you're going to be able to stop out, you're going to be able to cut your loss, whether it's yourself, whether it's using a stop loss, whether it's your broker stopping yourself out for you, whatever it is, you need to be able to cut your losses. So if you have a problem with cutting your losses, then yeah, short selling might not be for you. Again, I would say trading might not be for you, right? But at least when you're going long something, your downside is limited, which is zero, even though you should probably be cutting a long trade or something you're buying before it needs to go to zero to know you're wrong if you're trading it. That's why the short selling losses can be unlimited. But again, you can mitigate that. You can protect yourself against that with stop loss and good loss cutting. Okay, so that's number 1, the first thing you need to know. Number 2, knowing your fees. When it comes to short selling, there's a bit more of the fees on the expense side that doesn't come when you want to buy a stock. So what are those fees looking like? Well, if you're with a kind of a high net worth broker or call it direct access broker, you usually need to pay for a borrow fee. Now, what is a borrow fee? It is something that you have to receive shares before you can sell them. Hence, you sell them first in a short sell and buy them back second, right? The opposite of going long. You buy first, you sell second. Short selling, you sell first and you buy second. And to do so, you have to sell something that you don't even own yet. Hence, you have to borrow it from somebody, which is where the borrow fee comes in. You'd go up to your broker and you say, you want to borrow X amount of shares of stock ABC, right? Some ticker, XYZ, Apple, Tesla, you name it, whatever stock you want to short. In doing so and getting those borrows, you pay a small borrow fee. And again, the broker's going to tell you what that borrow fee is, and you need to be willing to be ready whether you want to pay that or not. If you don't want to pay it, then you don't get the borrows. If you want to pay it, you're going to pay the small borrow fee. Sometimes it's usually per cents per share. So if I want to say short a $10 stock and they're going to say, we're going to charge you 5 cents per share, well, then there you go. I'm going to borrow 1,000 shares of a $10 stock. I'm going to pay 50 bucks, 5 cents on 1,000 bucks right there. So hopefully that makes sense. So those are the borrow fees. The next kind of fees you need to be aware about is obviously commissions. Usually when you're short selling, depending on what broker you use, not all brokers have 0 commissions, right? We like to think that every broker you use nowadays is free commissions. Not all are. So again, talk to the broker you're using, learn what your commissions are. They could be free, but and again, if it's a direct access broker, it's probably not. Last but not least, the other important fee to know is that if you're ever starting to short a stock overnight, if you're ever going to start holding a stock short for more than one day, if you're going to start swing trading it and not day trading it, there is now overnight interest. And the reason why that is because when you are borrowing shares, back to that borrow fee scenario, when you borrow shares, it's kind of like you're borrowing money.
Where's my money?
You're borrowing a loan. You're taking a loan out, not as big as a mortgage, right? Not as big as, on your credit score, right? But it's a smaller short-term loan from your broker, from those shares you're borrowing. And again, for every day you hold them overnight, you're gonna pay interest on that loan, again, in this hypothetical scenario. And so knowing what that interest rate is very important because there are certain stocks that can be very popular short sell. And when they get very popular and all the other short sellers in the short selling world wanna borrow them and short them as well, all of a sudden your annual interest rate might become 100, 200, 200, 300%. Now, granted, you only pay that much if you hold the stock short for a full year. But again, if a stock interest annual rate is like 300% and you hold it, actually, let's do it this way. If you hold a stock overnight that has an annual interest rate of 365%, 365 days in a year, theoretically, you're going to be paying 1% every single night you hold overnight. Again, this is a very basic example. You have to really question yourself. Do you want to be holding a stock overnight and in doing so paying 1% of the stock's price? So again, back to that $10 stock example. You short a stock at 10 bucks. Do you want to pay 10 cents overnight? Maybe you do. Maybe tomorrow, the very next day, the stock drops 10%, 20%, and it's worth paying that fee. But you need to figure out and decide if that fee's worth it. Because again, if you don't, and you're getting caught with a fee, and you're like, where did this come from? You became underprepared. So again, that's something you need to know. You need to be able to judge and gauge those fees and if it's worth it to take that trade on a short side. Number 3 thing you need to know is knowing and understanding what the 250 rule is. Now, what is the 250 rule? Any stock that you look to short, and again, this is very applicable for the penny stock world, the small cap land, any stock you short under $2.50 needs to have at least $2.50 in your account per share that you short. So let's say I short a stock at $1, right? Let's keep it nice and round at $1, and I short 1,000 shares. Well, $1 times 1,000 shares is $1,000. So you'd think you only need $1,000 in your brokerage account to short that stock. But with the 250 rule, you'd be wrong. You have to have $2,500 to short, or $2,500 in your account, dollar-wise, to short 1,000 shares of a $1 stock. So instead of doing the $1 times 1,000 shares, you're actually doing the 1,000 shares times 250, hence the 250 rule, to give you enough dollar size in your actual account to have your broker let you actually short that stock in the first place. Now, why is this important? Well, one, brokers do it to protect you. Again, back to the unlimited losses example in short selling. Any broker that sees you shorting a stock below 250 knows that a stock that small could really increase in price very quickly. $1 stock could easily go to $2, and that means it'd easily go to 250. Why can't it easily go to 3? Because it could. But the point is they've picked the rule, they've decided to go with 250. And so again, if you're shorting any stock below 250, they want to make sure you have that as much money to have the stock be at 250. Okay, hopefully that makes sense. Now, the important part to know about this is why I've always been against shorting stocks that are too low price. And you might think me talking about a $1 or $2 stock is too low price. I'm talking about even lower. I'm talking about shorting a 5-cent stock, a 10-cent stock, a 20-cent stock even, right? Because again, back to that example of shorting, let's say 1,000 shares of a 20-cent stock, well, that's only $200, but you need $2,500 to do that. Extrapolate that out to me having a, let's call it $1 million account, and I want to short $100,000 of a 10-cent stock, but I need $250,000 of buying power or of equity in my account to do that. It's not worth it for me. It's not worth it. On top of that, the commissions are going to be exuberant. They're going to be extremely high when I short something that low. So again, putting those factors together is never why I've been a fan of wanting to short really low price stocks. And I'm talking about, 20, 30 cents, maybe even 40 cents. Really, I like to keep it 50 or above, but hopefully you see that point. That 250 rule really changes the dynamic and ultimately takes a lot of buying power out of your account to really short something that it's just low price. It's too low price. It's not fun. It's not exciting. And again, it doesn't mean trading has to be fun and exciting, but it's kind of counterintuitive. And there's some parts of trading that are counterintuitive and it's a good thing, but this isn't one of them, right? So I avoid that for that reason. Understand that's what the 250 rule does to your account and when you're shorting stocks under 250. Number 4, what you're shorting and why you're shorting it, right? Just because you now learn the first 3 things to know and all of a sudden you feel comfortable short selling, well, that doesn't mean you should just jump in and short sell whatever you want. And this should be the same for whether you're buying a stock, right? Really, any trading strategy, forget just short selling. This is kind of applicable for all the worlds of trading. Know why you're trading something. Know why you're shorting something. Know why you're buying something. I don't want to just gamble and buy something because I think it's going to go up. I don't want to just gamble and short something because I think it's going to go down. Don't do what I did. I did that when I first started trading. And guess what it led to? Losses, a lot of them over time. Bled my account dry down 70% at one point, okay? And I've heard many other stories where people just blow up and lose their entire account, right? I was kind of one of the lucky ones. When you are shorting something, figure out, again, what are you shorting? Are you shorting Apple, one of the best stocks in the market? You can, but it's probably not that smart of a thing to do. Or are you shorting a pump and up, a complete scam? Or are you shorting a company that has no revenues and is gonna fail long term? That's more of a fundamental point of view on it, but know what you're shorting and why you're shorting it. Have a plan, have a strategy, have a process. Don't just kind of willy-nilly pick whatever you want. Because again, you can do that, but if you're gonna be shocked and surprised as to why you're taking more losses than you're taking gains, you shouldn't be, okay? So that's number 4. And lastly, the 5th thing you need to know when short selling is knowing and understanding what SSR is. Now, SSR stands for short seller restriction, and let's talk about that. What is that? When you are shorting a stock on a listed exchange, meaning that is NASDAQ, that is a New York Stock Exchange, that is Amex. Where now I didn't say OTC because OTCs don't deal with SSR. Only listed exchanges deal with SSR. So when you're shorting a listed stock, when a listed stock has dropped 10% or more on the day, SSR, short seller restriction, gets activated. What that means is, as a short seller, you no longer can hit the bid to get in on your short position. If it stock's only down, say 5% of the day, and it hasn't gone down 10% yet, you can just immediately short sell and sell right into the bid. You'll get filled just fine if the stock's liquid or not illiquid, and you'll be in a position, you'll be trading. But when the stock's gone down 10%, it's triggered, and now that means it can go back up to 5% and SSR is still on. Once it goes down 10%, it is triggered, and then it can be up 100% of the day. But the point is, because it hit down 10%, it'll be triggered all day that day and all day the next day until it has a day where it hasn't gone down 10%. So that's how long SSR can last. And it's annoying if you're a short seller, because once it's triggered, you have to sit on the ask. You have to theoretically and literally have someone else buy into you, right? If there's bidders and sellers, or buyers and sellers right here, I have to physically have another buyer hit my sell order. I can no longer hit his buy order, if that makes sense, right? Again, in terms of a level 2 example, SSR prevents short sellers from doing that. Why? Because you kind of want to help prevent short sellers from really crushing a stock, right? If there was no SSR, theoretically someone with enough money could just keep selling shares more and more and more into the bid and push the stock down really, really low. Now, granted, the same thing can happen with you buying a stock. Someone can have a ton of money and just keep buying it up and up and up and up. Again, that's a whole other conversation. But the point is, bullish is good in a lot of people's eyes and bearish is bad. So this rule has come into place to prevent people from, having a bear raid, what they want to call it, or a short attack, right? I'm sure you've heard that a lot of things. And sometimes it can exist, but it's very rare, especially when short sale is on. It's actually impossible when SSR is on. And so when you see people say that and you see that stock is on SSR, it shows you it's not true. But again, that's why the rules are put in place. So understand why that exists. Know if you're not getting filled and you wonder why, and you see it's on SSR, that's why. Your order is actually sitting on the ask and waiting to get bought into versus just filling right away in the bid. So long explanation there. Hopefully you understand. Those are the 5 things you should know when you're a beginner short seller. Before you should ever place your first short trade, you should know these 5 things to be better prepared. Again, don't be like me and learning these things on the way like I did. Took many losses on doing so, but it was all worth it in the end. And here I'm now sharing that knowledge, passing it down to you guys. So thanks so much for watching, guys. Make sure you like and subscribe. I will see you guys in the next video and see you then. Bye.